I think if we look at what our clients, our institutional investors are doing, they're starting, or they finished the 2024 with a little bit more of a risk-off sentiment. They were a little more cautious. They started the year the same way, not tremendously risk-off, but really paring back some of those risk bets and getting more towards neutral. That meant that they're starting to be a little more dollar friendly again. They are looking at more of the quality equities piece of the pie, but they're really not going head over heels into duration or the bond trade yet either. So I think that really sets us up for a number of decisions from an allocation perspective of what we have to think about. Is this going to be an absolute performance year or a relative performance year? Is it going to be another great equity year like the most of the street expects? Tremendously so, or is it going to be a little bit more challenging? And how do you position in that regard? And I think that's really what's going to occupy most people's minds in this first month of January. Where do I go? How do I think about this market?
Yeah, well, I mean, what is your best bet then, Dan, and how are you positioning client money? Because I got to say, we're coming off the back of 2 years of plus 20%. That's a pretty high bar to clear. Plus, there's increasing chatter about the Fed potentially doing a U-turn this year and actually starting to hike rates. We've had at least 2 or 3 guests telling us that.
Yeah, I'm not in the hike camp. I'm in a bit of a different camp, which I'll get to in a second. But let's address both sides of that. I think this is still an equities world. You just have to be careful about where your equities money goes. A lot has been priced in already. So, when we come to the dangers, there's 2 sides of the Trump trade. There's the opportunities and the dangers. When it comes to the dangers of the trade war and some of the tariffs and the immigration issues that we're dealing with, I think a lot of that's priced in. But I still think this is going to be a year where people are going to care a lot about actual earnings because there's just not going to be the same uplift to multiples that we've seen, and multiples remain really high. So earnings are going to be the driver. That means stick with the stuff that's earning with decent margins and has room to give, and that's still tech. I know that's boring to say at this point, but it's still there. If you want something new, then I think that healthcare is one of those areas that has great earnings expectations. Some of the multiples are a bit higher, but still it's stable earnings and stable margins with some great expectations going out for the next couple of years, which I think will actually hold up quite well. I'd be much more worried about the industrial side of the trade, materials, that reignition of growth, which we need a lot more evidence. And the banking sector is telling us that we shouldn't be too quick to get into that space yet because lending, CapEx, all of these kind of drivers that we need for a new growth burst are just not there yet. And that leads us to the last part, the Fed. I don't see it as a hike, but I see them having to react to more emergency features later in the year.